We expect to be well north of 200,000 ounces of annual production in 2025, with Mintails coming online and also then with the Evander underground expansion at the same time. Importantly, all of this growth is funded, either with banking facilities or with cash generated from operations. The coming 2 years will also see us moving towards an even more balanced portfolio of low-cost and stable surface remining and high-grade, long-life underground assets. This asset mix should also reduce our group all-in sustaining cost profile, with both Elikhulu and Mintails producing at an all-in sustaining cost of approximately $1,000 per ounce. We continuously seek ways of making our business less susceptible to adverse external impacts in South Africa. We are reducing our reliance on Eskom, the South African electricity utility. Pan-African's assets have long lives with extended mining rights. The Evander complex's rights are valid until 2038, and those at Barberton until 2051. The Mintails new order mining right is currently valid until 2029. We will obviously seek extension in due course. In terms of stakeholder interaction, we invest heavily in our social license to operate. Pan-African's mines make a meaningful positive impact in the areas where we operate. We have 1 year remaining on our Barberton wage agreement, and we are also very pleased to report today that the underground contractor at Evander recently entered into a 3-year wage agreement with their union, which will provide stability as we grow production from that asset. Finally, from a security perspective, our efforts to safeguard our people and operations and minimize the impact of illegal mining and criminality are ongoing. In the last year, we have definitely seen an improvement in terms of the illegal mining situation at Barberton, which is encouraging. Pan-African's track record demonstrates that we can operate and grow in South Africa and do so very successfully. With construction having commenced at our Barberton solar facility, we are set to almost double our behind-the-meter renewable energy footprint in the next year. We further anticipate first power from our 40-megawatt Sturdy Energy power purchase agreement in early 2025. You can also expect other announcements on renewables from Pan-African in the year ahead. Hopefully, we can add even more capacity and also possibly diversify into wind energy. The first 10-megawatt solar plant at Evander is already reducing the group all-in sustaining cost by more than $10 an ounce, with this number obviously increasing in coming years as Eskom tariffs continue to escalate. From a production perspective, our surface assets performed in line with expectations. In terms of costs, all-in sustaining costs came in line with revised guidance, with US dollar costs increasing by only some 3.3% despite higher US and South African inflation. Given the production headwinds, the group delivered a very resilient financial performance, with a strong rand gold price compensating for lower underground gold production. Importantly, we are maintaining what we believe is a very attractive dividend to shareholders, despite the large capital tickets for Mintails and for the Evander underground expansion. As you may know, in terms of upfront capital investment, Mintails is the largest single capital project we have ever undertaken. We've managed to fund all of this Mintails development capital without any call on shareholders, and we ended the financial year with very manageable net debt. If we then move on to more detail on the performance per operation, starting with Elikhulu, this really is a flagship asset for the group. 10 years of production remaining, producing at approximately $1,000 per ounce. Despite lower recoveries, production was stable, and looking forward, we expect another year of more than 50,000 ounces of production and clearly excellent cash flow generation in the current gold price environment. Elikhulu is testament that large mining projects can be successfully constructed in South Africa on budget and on schedule, and we are carrying all of the learnings on building and operating Elikhulu over to Mintails as we ramp up activities there. Another sterling performance from our first gold tailings retreatment plant, commissioned in 2013, and the lowest cost producer in the group. The BTRP management team also deserves special mention. By working on elution efficiencies and optimizing their process, they managed to reduce total costs, despite inflation in cyanide and other reagents. In the coming years, we will substitute the BTRP's feed with run-of-mine material from Royal Sheba and Western Cross. Lower grade but bulk ore bodies, with both having significant potential to further increase resources and reserves. Large-scale construction at Mintails is now underway. Despite almost 2 years having lapsed from when we completed the bankable study and some serious inflation recently, our team believe they can still deliver this project for upfront capital of some 2.5 billion rand or $135 million. Payback on this investment should be under 4 years, with a project life of more than 20 years when we include the Soweto resources. Now, South Africa has its issues, but where else can one acquire gold reserves, 2 million ounces on surface, for less than $2 per ounce? A picture of construction progress on the site, with commission scheduled for December 2024. And you can see that we are nicely on track in terms of project execution timelines. There is no doubting the benefit of Pan-African developing Mintails for all legitimate stakeholders. We currently have 200 contractors on site, more than 50% of them from local Mogale communities. Now, this number is set to increase to more than 500 staff on site in the months ahead, with even more locals benefiting. When steady state production is achieved, the operation will directly employ almost 400 permanent staff. Over the life of Mintails, it will also dramatically improve the environmental and water situation on site, a win-win for all involved. We calculate that the final closure liability will be less than 40% of what was an unfunded liability of more than $20 million when Pan-African became involved. We are building a world-class tailings retreatment business in the next 2 years, with further scope to grow also. I don't believe the market is currently giving us much credit for Mintails, but this should change as the project becomes closer to commissioning in 2024. The Evander underground team has delivered in line with expectations, despite electricity constraints and difficult mining conditions, producing more than 33,000 ounces for the year at an all-in sustaining cost of just over $1,050 per ounce. We are on track with our capital programs at Evander, and some highlights from the 12 months include progress with our new underground refrigeration infrastructure, with phase 2 due for commissioning in December of this year, a ramp up in tons from underground by more than 20% in the last year, despite challenging pillar mining conditions, completion of the dewatering of the Egoli decline to 19 level, with vamping activities set to commence in the coming months on the upper levels of this project, and finally, good progress with the development of our sub-vertical westing shaft, with this project scheduled for completion in Q1 of 2024. I really believe that this shaft, with a westing capacity of 40,000 tons per month, will be a game changer for Evander. No more cumbersome conveyors, lower costs with a higher mine call factor. Clearly, given a decline in production from Barberton underground in the last year, a key element of this results presentation is demonstrating progress with our initiatives to increase future production. Even though continuous operations took a bit longer to implement, I believe we still restructured in record time, to be fair. Tons at Fairview are up by almost 8% in the last months, gold production also. Other important initiatives at Fairview is opening up near-surface resources for mining and infrastructure improvements we are implementing, most importantly, the chairlift next to 3 decline. The other critical component at Fairview is increasing drilling, reducing production volatility in the years to come. At Sheba, continuous operations definitely having an impact, with production tons up almost 40% in the last month. Consort, it took us a bit longer to get the contractor going, but they are now firmly established and our mine plan reconfigured. The headcount has been reduced by more than 30% at this operation, and in the last months, tons and gold produced are up. We expect gold production of some 25 kilograms in September, returning Consort to a cash flow positive position. Mining of the MMR and the PC ore bodies will give this operation a life of many more years. More than 80% of our portfolio produced at an all-in sustaining cost of just over $1,150 per ounce. We expect unit costs at Fairview, Sheba and Consort to reduce in the new financial year, benefiting from the turnaround plans currently being implemented. Our cost performance on core operations continues to be very much in line with averages for the global sector, with most producers having experienced significant cost pressure in the last couple of years. Despite inflation, we should be able to maintain all-in sustaining costs at current levels in the coming financial year in US dollar terms. We continue to invest into our assets and into growth, with most of Mintails' upfront capex spent in the next year. For Evander, we expect capital to reduce from 2025, as most of the large capital for 24 to 26 levels would then have been spent. I'm happy to report that our Evander treatment plant for water is fully commissioned. At our Barberton Blueberries project, we are currently employing 300 community members, mostly women, in the second harvest, and also forecasting positive EBITDA for the venture this year. We would love to expand this operation further and create even more employment and opportunity. In terms of other ESG progress, we are issuing our very first TCFD report today. I'm also very pleased to report that this is the first year that we have limited assurance on 10 ESG KPIs, of which 5 relate to energy management and climate change, and 5 to important social aspects of our operations.